Hello, good morning, everyone. We will wait just a minute for some others to join, and then we'll go ahead and get started. Good morning, everyone. I'm Rob Wilson. We will go ahead and get started. It's 10 a.m., so let's kick this thing off. One point before we get into the content, you see the screen in front of you. The NGL Insider is a weekly free publication on the NGL markets. If you haven't already, please go ahead and sign up using the giant QR code on the right-hand side of your screen. Okay, so look, the NGL markets is very exciting right now. It's good to be here this morning and talking with you through some of the interesting dynamics we are seeing and talking about. On the screen is the NGL product suite. Everything you see in our webinar is developed using our products here. So if you're interested in learning more as we talk through a few key market dynamics, my contact information is here. Email is rwilson@eastdaily.com. If you use the QR code and you reach out doing that, I will get your message, so it'll go directly to me. Okay, so let's get into it. Crude oil, natural gas, and NGLs, any constraints, all. And really, this is a webinar and a series of webinars. We did one recently on natural gas and crude oil as well as part of our third quarter 24 market updates. If you would like the recording or presentation for either of those, please reach out to me or Jim Simpson or Alex Gafford. For crude and natural gas. You can also reach out to me. But we've all been talking about increased volatility and the impact on infrastructure. And there's really three things to remember. The first is production and capacity in the fastest growing basin in the US has doubled in 6 years, and we'll go through that pretty quickly. But growing supply into a larger demand market with little investment in storage, i.e. the buffer, will lead to increased or heightened price volatility. The second thing, crude oil, natural gas, and NGLs are linked together in ways in which they have never been in history. You cannot simply just focus on crude or gas. They are all linked together. And a couple examples we'll talk about today is Matterhorn being the catalyst for propane growth and the chameleon molecule ethane. Both are amidst very dynamic markets, and we'll talk through each of those. No current market participant has ever traded or spent capital in a market like this. The U.S. has never been the major world supplier of all three hydrocarbons in the lifetime of anyone on this webinar. And we'll use the Bakken and ONEOK and more recently Kinder Morgan's call option on ethane demand as the last of three key takeaways of this webinar. But first, let's talk about growing supply into a larger demand market. And this is something, if you've followed us before, you know we've been talking about. When you look at the largest basin in the U.S., the Permian, no matter what molecule you look at, whether you're looking at residue gas egress or crude egress or NGLs, capacity and production has either doubled or tripled for all three molecules in the last, call it 6, 7, 8 years. So this is meaningful growth, like doubled or tripled in the last 6, 7 years is significant. I think one way you can get an idea for how significant that is look at price. This is one example. We're using Waha the Waha gas price in the Permian as somewhat of a canary in the coal mine for other markets, not just gas, but crude and NGLs as they expand into bigger markets without growing infrastructure in place via storage to buffer the changes in supply and demand. And what I mean by that is a lot of the demand coming online is happens more abruptly. The supply is slow to ramp up. It's slow to slow down in the case of weather event maintenance. And so when you're trying to juggle bigger components of supply and demand with the same amount of storage, you're going to get more volatility, and certainly that's what we've seen. So let's get into the second point. Crude oil, natural gas, and NGLs are linked together in ways in which they have never been in history. And let's talk through the first point, Matterhorn, the catalyst for propane growth. And before we get specific into propane, I always like to go the view from 30,000 feet, or what is our forecast, our base forecast for crude oil, dry gas, and NGL production. And you can see it on the screen here. Couple points to remember. One, the shape of gas supply growth is different than the liquids, crude oil and NGLs. And that's because a couple of the larger producing basins, the Northeast and the Marcellus and the Haynesville, are much more volatile to low gas prices. And certainly we've seen significant volatility to the downside, which has pulled more gas off the market than crude or NGLs from those two basins. And we've seen the curtailments from producers like Chesapeake, who just don't want to produce into very low gas price environments. The growth you can see is consistent with the Matterhorn in service date, which we have line fill beginning October 1st. Possible it starts a little bit earlier on September 15th, but we model out line fill October 1st. And then also ramp gas supply consistent with LNG facility ramp ups, Plaquemines, and Corpus Christi 3. NGLs have grown more than crude or gas in 24, and I'll show you exactly why. But the Permian gas egress constraints have been a big part of that. So the fastest growing hydrocarbon class of the three we're talking about today is NGLs. Matterhorn, again, we talked about this, is expected to be online by mid-September, which will allow, we model line fill October 1st, which will allow gas, oil, and NGL supply from the Permian to grow. The timing of Blackcomb becomes critical to avoid more gas paid in 26. And if you want to dive into our Permian S&D on the gas side, please reach out. We see tightness before that pipeline comes online. But in the near term, Matterhorn does allow producers to grow into what they said they have been communicating they would since really February this year when they established budgets and production forecasts. So far, growth has been mild, and this is from DEC 23 to June 24. You can see it's actually decreased slightly, and the Permian has been a big part of that. The Permian and freeze off. So we had Winter Storm Heather in January and gas egress constraints out of the Permian, which has really limited any sort of growth in the first half of the year. Don't be fooled by what we've seen the first 6 months, though. We do believe the growth will come predominantly out of the Permian in the second half of the year. And you can see right there, the Permian is the one leading the charge. And indeed, Matterhorn will allow for that growth in the fourth quarter this year. And we have 180,000 barrels a day, average 23 to first half 24. So why do we believe it's actually going to happen? Well, producers that have guided to growth have doubled down on the growth they've been talking about. So a few producers we've highlighted here. ExxonMobil is one that has consistently said they're going to grow at a compound annual growth rate, 23 to 27. by 13%. And this growth is lumpy, or they telegraphed that the growth would be lumpy, and we're seeing it now, flat to slightly down for some producers first half of the year into significant growth for Q24. Vital Energy and Matador are a couple smaller independent producers that are growing, 20+%. And then Chevron, we have growing 10%, 23 to 24 average. If you look at the what they said in their 2Q24 earnings call, they actually upped their guidance. So in February of this year, they said they would taper production first half of the year, again, consistent with what we've seen, to build, I'm paraphrasing, operational ducts so that when Matterhorn comes online, they can grow into that. The only change is they've gone from 900,000 barrels a day of oil equivalent to 940,000 barrels a day. So that's the only change, is actually increasing their guidance, and we've seen this from a couple other producers as well. So the 5.5% growth we have 23 to 24, or crude growth of 322,000 barrels a day, we think is very realistic. Again, based on infrastructure and what producers are saying. So now, what does that mean getting into the NGL component for propane supply growth? What you see here is our propane outlook or production by month. And from October 24 to March 25, we have 40,000 barrels a day of C3 growth. And to get to total NGL growth, I mean, take 40 divided by about 0.3, gets you called 133,000 barrels a day of total NGL growth. And again, that's enabled by an operational Matterhorn anywhere between September 15th and, as modeled, October 1st line fill. The Permian is the basin that, again, leading the charge here, and you can see about 100,000 barrels a day of growth from 23 to 24, and almost another 100,000 barrels a day growth from 24 to 25. And that's all Permian. There's a one note I want to make, and I'll go into this in a little bit more detail, but the reason for the green up arrow is higher gas IP rates that we've seen in the Midland sub-basin. I think there's actually upside to our forecast. And quick footnote, we update our forecasts on a monthly basis for all the producing basins in the lower 48. What I'd expect to see is an increase in that number in our forecast released, or our next iteration of forecasts here released in the next day or two, because of some of that increased IP rate. And before we hit the Midland sub-basin where we're seeing that, the question is often, well, do we have infrastructure available to move that molecule, be it gas, crude, or NGLs, in this case propane? Do we have enough infrastructure to move that molecule? And the answer here in the Delaware certainly is yes. There are pockets of tightness, but overall, there's 3.5 BCF a day of plant expansions announced through 2026. Over half of those are built by the vertically integrated behemoths, so Enterprise, Energy Transfer, and Targa. There are a number of other players, MPLX, Kinetic, Western Midstream, Inlink, Matador, and EOG are a couple upstream producers, or upstream players that are also building capacity, another 1.7. So plenty of capacity, and we do need it. The gas IP rate in the Delaware, almost 2,700 MCF per day, more than 3 times higher than what we're seeing in the Midland sub-basin. However, as we noted earlier, we are seeing an increase in IP rates in the Midland over the last 12 months or so. And so the forecast we used last month, very likely the IP rate in the Midland sub-basin will be increased. So the infrastructure overbuild that looks apparent if you look at the blue shaded region, which is rich gas production growth. It's not quite as overbuild if you use an IP rate of 850 MCF a day. And so the rich gas increase, Y-grade NGL and propane increase from using an 850 IP versus 770 is 40,000 barrels a day of propane upside. So it's meaningful. Again, divide by about 0.3 to get the Y-grade impact, which again is about 130,000 barrels a day. And then in the Midland Sub-Basin, and this is recent in the last, call it year, the 2 BCF of plant expansions are much more consolidated, in part because some of the plant expansions are from WTG, or what is now Energy Transfer. And they're accounting for almost 80% of the increased infrastructure. So again, the integrated behemoths leading the charge there and ensuring that all the NGL production, propane included, has a pathway to market, which in the near term it certainly does. And then PSX, with their recent acquisition of Pinnacle, is strategically important from the perspective of securing NGL production for the pipeline they now own through the DCP acquisition, Sandhills. And Brazos also has a plant in the Midland Sub-Basin as well. So the next, excuse me, the next piece of the value chain is Y-grade. And the Y-grade capacity with respect to production has been very tight. And actually, there was a chance, or it will be extremely tight leading to Matterhorn. But a couple things happened. What I was going to say is Matterhorn comes online, let's call it Oct 1, and all of the NGL pipeline expansions were set to come online early 25 or very end of 24. The announcements from Targa and ONEOK from the 2Q24 earnings calls were they're bumping up their expansions to 3Q and 4Q24 respectively, or as early as 3Q. I think Targa said could be 4Q, but it could be as early as 3Q. This is important because you're getting almost 600,000 barrels a day of expansion capacity in line with Matterhorn. So if Matterhorn came online and you didn't get any NGL infrastructure in line with that timing, you might be looking at a lot more ethane rejection to clear the path for, really that would be the only place you could put it, down a residue gas pipeline if you didn't have any more room on the NGL side. Now, given that those projects have been bumped up relative to initial expectations, should be plenty of capacity, and the timing fits very nicely, and frankly is very good for Targa. You saw Targa increase their guidance for EBITDA in the year. Clearly, they expect to get to ramp up Daytona before year end as well, with a lot of that producer production growth we've been talking about. So it all kind of lines up if you think about what producers are saying with respect to the timing of infrastructure new builds. And then one other thing just to point out is the table on the left does show you NGL production divided by pipe capacity as a percent. Clearly it's better, or we believe it's better if you actually own the NGL production that feeds your own pipes. This is why you see strategic acquisitions like Energy Transfer of WTG or PSX of Pinnacles to secure those volumes. Yes, you can contract them as well, but there are pipelines that have more perceived risk because they don't own the NGL barrels, and included as ONEOK's West Texas NGL and Epic NGL pipelines. Moving further downstream, and we're going in the sake of timing, we're going to skip fractionation capacity, but that remains tight despite the expansion fractionators that have been announced. If you want to drill into more detail on that, happy to. We can go frac by frac, project by project to see what utilization looks like over time. So space on the GNP side of or closest to the wellhead, space on NGL long haul or egress pipelines about to open up. But in the near future, this winter, we would expect LPG exports to be extremely tight because as you get Permian production flooding Mont Belvieu, so more propane and butane, with continued international demand, all of that's going to happen before the meaningful LPG export capacity that's scheduled. And there is a lot of capacity scheduled. Energy Transfer's Netherlands facilities 250 a day. Targa has a 25 a day expansion, 4Q 25, and then Enterprise has 0 to 360 a day. And the reason that there's the range is because that can flip from LPG capacity to ethane capacity. And Enterprise has already said that they've 100% contracted Neches River. So that will at some point become exclusively used for ethane exports. We believe they'll use some of the capacity for LPGs until those contracts ramp up to 100%. And then the Houston Ship Channel dredging project, we estimate adds another 75 a day capacity. And then finally, end of year 26, Enterprise's EHT refrigeration 4 expansion project is a 300 day expansion by the end of 26. We do discount the ability to export at Neches River because of what we already talked about is the conversion to ethane. It's not going to happen day one, but we flag it or put an X over it because at some point that capacity will not be available for LPG exports. From a propane storage and price outlook, you can see our outlook in the blue shaded graph relative to the 5-year max and the 5-year min. The 5-year max is based on historical storage norms. So we would expect, given the increased demand going internationally, that the max becomes even higher because we're frankly just exporting more LPG and propane to PDH facilities predominantly in South and East China. It's not exclusively going there, but that's what's driving a lot of the demand for US propane supply. And we've seen increased demand already. LPG exports are up 10% year to date through May in 24 versus 23. And international demand is pulling on that Permian supply growth. There's about, we estimate 500 plus thousand barrels a day of propane demand from PDH facilities coming online in 24 and 25. Now, the utilization of those facilities could certainly be debated, but we do believe supply growth end of year 24 and LPG exports pushing up on dock constraints will present some downside risk to the forward Mont Belvieu C3 price. So we've gone through, what increased production and capacity means to price. We've gone through or talked through Matterhorn and the impact that has on propane growth. The next thing, which is really interesting in discussions, is ethane, and it really is a chameleon molecule, and that has behaved differently than all other hydrocarbon streams, even though it's certainly impacted by other hydrocarbons, i.e. natural gas egress out of the Permian. So if you look back into 4Q of 23, NGLs, nat gas, and crude hit record highs. And then, as we talked about, gas production remained lower due to low gas prices. Certainly that signaled on lower supply hitting the market, and we saw the curtailments that resulted. From an ethane perspective, we saw new production records in March 24, April, and May. And it's a really good case study actually for the ability of Permian processing plants to extract ethane in a market that really has nowhere to put gas. So if there was ever a time that these plants would be incentivized to extract ethane, it's probably April, May. At the height of that, that those plants are just extracting as much as possible. There is plant data, and I would be happy to talk through the plant data we have on that we have at a plant and system level that shows ethane, propane, butanes, and natural gasoline or C5 plus produced out of those plants. That gives you an indication of, okay, well, what systems or plants are more sensitive to the frac spread versus others. And I say that because if you look at the Permian overall and you compare something like Waha gas price to Mont Belvieu C2 prices, the correlation is kind of sloppy. And there are reasons for that. The incentives behind certain systems or who can elect to extract or reject is a little bit different depending on what the contract structure is. That's where it's beneficial to kind of dig down deep into the detail and really take a bottoms up approach to what's happening in a basin like the Permian. And one example that's helpful as well is if you're trying to get a read on what ethane is doing in a basin like the Permian, it is helpful to look at that plant data because it does lead by a month or two what the EIA reports. And certainly in the lower left-hand part of the slide, this shows ethane month-over-month growth as indicated by state data available in our Energy Data Studio compared to the gold bar chart ethane production per the EIA. So the blue chart is available before the gold chart, and you can see the correlation is relatively high. So if you want to have a leading indication of what's happening with supply, ethane supply, it's a helpful tool. So what do we expect? Well, short term, we expect ethane rejection to increase at the margin as Matterhorn supports higher Waha prices and consequently narrows the frac spread. We don't think, plants are going to, go all out on rejection, but we do think they'll back off extraction a little bit because there's space to do it. Long term, ethane will certainly be required to meet international demand. The 150,000 barrels a day of ethane trapped in North Dakota, 150,000 barrels a day plus trapped in the Bakken is really a call option without expiration, meaning as ethylene demand comes online internationally or domestically, demand for ethane will increase, and certainly that's one spot where we would expect to see price signal more ethane extraction. And again, revisiting the three main points, the third one, no current market participant has ever traded or spent capital in a market like this. The US has never been the major world supplier of all three hydrocarbons. So, whether you look at natural gas to LNG, crude's been exported for a long time, but not at the scale it is today. LPGs is no different, and certainly ethane is no different. Enterprise just said they're got 450 of ethane contracts going up to or with line of sight to 550. I mean, this is a significant change in the ethane market. And depending on how many ethylene crackers come online, there are midstream players in the Bakken that would benefit in the sense of contracting for supply for an end user who needs that ethane, that cheap ethane, to crack ethane. So as we pivot to the Bakken, there's a couple points to make. And we've been talking mostly about the Permian since that's where propane supply growth is coming from. And that's where ethane supply is most dynamic. What is different about the Bakken is that it's dominated by a few, certainly a fewer number of players on the midstream and the upstream side of the equation. So on the NGL side, ONEOK, Kinder Morgan, Hess Midstream, now owned by Hess, and Targa are a few, soon to be owned by Chevron, are a few of the bigger players in the Bakken. On the upstream side, M&A activity has significantly consolidated producers in the last 6 months. 80% of the production is from these 8 producers, and all are considering growth ramifications in a relatively tight egress market for all 3 commodity streams. So let's take a minute to talk through that. The main supplier of crude oil into PADD 2 is via North Dakota Pipeline and DAPL. The first thing to really notice here is the red line on the chart, which is effective capacity. This is a tight market. Our growth forecast does not exceed egress constraints, but it is a tight market. To keep drilling in the Bakken and to grow the crude oil supply, you've got to be able to move the gas. When you look at the gas market, sorry, I'll go through that a little quicker, and this is just showing kind of the interconnectivity of the 3 molecules, no different than the Permian in this regard. When you look at the gas market, it's also very tight. There are a couple things that are unique to gas production in North Dakota, and one is you can flare gas from the day of first production for the first year. The second thing is the Bakken does produce rich gas, so stripping out NGLs does effectively create more space for gas, especially in regards to ethane extraction. And so, as much ethane as possible is being rejected into the gas stream, which exacerbates the tightness. Should price call on more ethane for ethylene crackers, that would help incentivize more ethane extraction and therefore relieve gas egress constraints. And finally, what does the NGL market look like? Well, it is a very tight market now. It certainly opens up with the Elk Creek expansion expected to be in service 1Q25. This expansion will allow all 3 commodities to grow. Now, one thing to note, and this will be updated in next month's product, but is the double H conversion. And so let's talk a little bit about that. And we call this the NGL box around the Bakken. So this is a map of the Bakken here on the top side of the chart. And NGL production for the trailing 12 months or last 4 quarters into 3/30/1/24 is 444,000 barrels per day. The main demand for that wide-grade NGL production is ONEOK's Bakken NGL line and ONEOK's Elk Creek NGL line. And the Bakken line largely gathers for wide-grade NGL in the Bakken and then transports or offloads it onto Elk Creek down to the Conway or Bellevue markets. You can't see Bellevue, but the Conway is the star in the lower right hand part of the map. C2 is stripped out of the wide-grade stream and sent north to on Vantage pipeline into Canada to the Nova cracker. That's 32 a day over the last year. And there is a new cracker, the Dow cracker in Alberta. We don't believe we'll see more C2 volume, but that is 32 a day that's going into Canada specifically for ethane. On the fractionation side, about 70 a day of demand is being fractionated, and for C3, it's trucked or railed to local markets. Hess Midstream also has the ability to inject propane into Alliance pipelines towards Chicago, including Aux Sable, the Aux Sable plant there. And then C4 is truck to rail to local markets. We've also been hearing a lot of that's blended with crude oil and transported to markets as a blended crude product. The infrastructure developments we talked about, double H, converting from crude oil to NGL service in 1Q26 for an additional 85 a day of NGL capacity. This actually does tighten even further the crude constraint out of the Bakken, and we do expect to see an announcement as far as a crude expansion project to ensure that hydrocarbon growth out of the Bakken is not restricted by crude oil and the ability to ship crude to market. And then the Elk Creek expansion, ONEOK expanding its existing pipeline capacity in here in the near term, 1Q25 by 135 a day. So why? We saw that the market is fairly tight, but it's not out of balance. And so, as of today, so capacity is very tight, especially when you account for downstream bottlenecks. And what I've shown here on the blue arrow is there is about 53,000 barrels a day of NGLs that goes down Elk Creek on out of the Powder River. So that effectively reduces your upstream capacity by 53 a day. So your effective capacity is actually tighter than, if you just look at nameplate capacity. Two, it does provide shippers with counterparty optionality, especially in the case of Double H, owned by Kinder Morgan. And that's important because ONEOK basically dominates this market. You can see the map today. ONEOK owns Elk Creek, ONEOK owns the Bakken. So it does provide some optionality for shippers. And the third, which is how we teed up this conversation, is it does provide a low-cost infrastructure capability to ship ethane to market should price incentivize more extraction. And further on that point, to our clients, we will hit your inbox shortly in a follow-up to this webinar for opportunities to, what this means to midstream companies on the ethane supply if you're an in-demand user or ethane and contracting ethane on NGL volumes if you're a midstream operator. So we'll go into a little bit more detail about what that means to the midstream operators. Again, on the screen is the NGL product suite. Everything you see in our webinar is developed using our products here. If you're interested in learning more, like I said, call me, email me, rwilson@eastdaily.com. If you click the QR code, that'll also send any requests or questions, clarifications you have to me as well. So thank you so much, everyone, for joining today and being part of, what is as interesting of an NGL market as I've seen. There's a ton going on, and would really encourage you to reach out if you have any questions or if there's anything we can help you out with. Thanks again for joining today, and have a great rest of the week.